How to finance a mobile home park investment. That's what we're going to talk about today. But the question is, what's so good about mobile home parks and why finance and why create this video? It's because mobile home parks, number one, are one of the last greatest hidden gems in commercial real estate in terms of popularity. Okay, you'll soon find out why. Number two, mobile home parks have a shrinking supply but growing demand. Cities don't want brand new mobile home parks, right? So you're not going to walk down the street and see grand opening of a brand new mobile home park. You're not going to see it. So we have this static supply or shrinking supply of available mobile home parks, but the demand is greater because our country has a housing unit shortage. So mobile home parks are one of the last affordable housing solutions for our country's housing issues. Okay. And number three, buying the right park at the right price in the right area is going to lend to you a great return on your investment, long-term cash flow that's consistent, longer tenant stays, right? Reduced or lower operating costs compared to other commercial real estate, and the awesome tax benefits that go along with it. That's why you should buy mobile home parks, or at least look into them. And this video, I'm going to share with you how to finance them. And I'm going to share that with you using 3 subsections. And then at the end, I'm going to share with you the 3 most pressing questions when considering financing a mobile home park. Let's get started, okay? Number one is, this is the first of 3 sections I'm going to go over with you, is the small park financing, okay? This is a smaller mom and pop park where the loan amount is under $1 million. Okay, this is where most of you will probably play. Most of our students play here between these two. And guess what? You think you need experience here? You don't. Now, I'll share with you why. You don't need experience here. And number 2 is creative financing. What if the mobile home park itself has high vacancy, or it has inconsistent income, or has some repair issues, or just way ugly, right? Or what if you don't qualify for loan? So either the park doesn't qualify for loan or you don't qualify for loan. You're going to have to do creative financing, and there's quite a bit of that in the mobile home park financing world, and I will share with you how to do that, okay? And number 3, what I call large park financing. This is for loan amounts over $1 million, and I'll share with you how we've financed those types of parks. And then lastly, I'll go with you the 3 most important questions when considering mobile home park financing. Is number 1 is, how do I finance a park with 50% vacancy? And that's a tough one, okay? Because a lot of small parks will have this when you go direct. How do you deal with that? Do you just pass it up? No, you don't pass it up. I'll share with you how to deal with that, okay? And number 2 is, how do I finance a mobile home park with a lot of park-owned homes? Park-owned homes are where the landlord owns the home on the lot, so the tenant is paying rent for the home and the dirt. And lenders don't like that. Lenders only want to lend ideally on the dirt and not on this rapidly dilapidating home, okay? So how do you finance something like that? And the reason I need to share this with you is, when you go direct, like most of our students do, you're going to find a lot of these, okay? Where most of the parks are not just getting lot rent, they're getting rent on the homes and on the dirt. And number 3, as a beginner, that may be you, where do you start? I'm going to share with you exactly where to start and how to get started. All right, so let's get started with number 1, small park financing. All right, here we are with small park financing. This is the first category, okay? Small park financing. Now, our student purchased this small mobile home park with huge value add using a hard money loan. That's how she financed it. Incredible deal, right? And I want you to see the link and watch the video. So small park financing, what I'm referring to when I say small park, are loans that are under $1 million. And typically the parks are mom and pop owned and operated. Okay, not some huge corporation, but usually it's a husband or wife, or just a husband, or just a small family that owns the park and runs it, and that's all they have, okay? And this is a perfect way for beginners to begin, by the way, right? Is with a smaller park, okay? Get your feet wet, probably the safest way. Now, for the best financing, for the small park financing, no, we don't want to have the park to have any major distress, such as maybe the homes are in a horrible condition, no skirts, just torn down. We don't want that, okay? We don't want the roads to be in horrible condition. Bank sees that as a distressed property, and where the utilities are broken down and non-existent or just in really bad shape. You get the picture, okay? So the park has to be relatively and generally decent condition, okay? That defines a small park. The financing will look like this, okay? The lender would be a small local lender. And why a small local lender is because a local lender has orders from the top to loan throughout their community, okay, to get loans done. And so you want to also approach the small local lender and also the community bank. And another thing you can do is, if you're in a small city, start off with the largest bank in that city. Okay, that's one way to start. And you can just basically Google local lender or banks in that, if it's a small town, and you can start there. The other thing is, you're going to have to call lots of them, lots of lenders, 5 or 10 lenders, just to get your loan done. And the reason why is, a lot of lenders don't want to do a loan on mobile home parks. They don't. Okay, they would rather do apartments or anything else, not mobile home parks. So you're going to have to find a lender that's okay with lending on a mobile home park. So that's why you have to call them, right? This student found that lender and was quite local, right? Because they had orders to lend throughout the community, and she was one of them. All right. Also, I want to just say this, okay? Many of our beginning students had no experience when buying their first commercial property, which happened to be a mobile home park, and they got approved. So they had good credit, they had the down payment, and the park performed. So they're able to get a loan with no experience, okay? A lot of people say you need experience, but our students did not have experience, but they had good credit, they had the down payment, and the park performed. They were able to get a loan. And let me say this, you have to start someplace, right? And if you look at the most successful person you can imagine real estate-wise, they had to start someplace too, okay? I started multifamily without any experience, okay? I just had single family experience. So you can get approved, and you likely get approved if it's a small park, okay? Got it? All right, so for the small park financing, it's going to be generally loan to value 70 to 80%, meaning 20 to 30% down, and it'll be a 5 or 7 year term or balloon. Okay, so they're not going to give you a 30-year loan on the mobile home park. The loan is going to become due and payable in 5 or 7 years, but it'll be amortized over 20 or 25 years. Not the best terms, of course, right? Because it's a small park and you're a beginner, but at least you can get it done. Also, expect to pay a higher interest rate due to the loan size. The smaller the loan, the higher the interest rate is. And when you're a beginner, the lender is going to mitigate their risk by charging you a higher interest rate. So be prepared for that, okay? All right, and the loan will be recourse. What does recourse mean? Recourse means that you are personally guaranteeing the loan. When you get into commercial loans that are over $1 million, you can get a non-recourse loan, meaning that there's no personal guarantee. That means if something happens where you fail and you have to walk away from the loan, they won't come after you, okay? That's a non-recourse. These smaller loans are recourse, meaning that you are personally guaranteeing a loan. That means if you walk away from a loan, they're going to come after you, okay? So these are recourse. There will be a prepay penalty. Usually it's 1% or 2%, and sometimes what we have is called a step-down pre-penalty structure, meaning if it's a 5-year loan, the prepay penalty goes in percentages of 5, 4, 3, 2, 1%. Got it? Okay? All right. So that is how to finance smaller parks. Watch this video of Gilda and how she took down her small park. It was only 8 mobile home spots, but she could literally triple the amount of homes on that piece of land, and the banks are financing it. So check it out. All right, okay, so that's that. Let's get to one of my favorites, and that is creative financing. Number 2, creative financing. This is my favorite part of the video because I believe at Commercial Property Advisors, we're the best at this. I truly believe that. All right, so let me set up the scenarios around seller financing and what the issues and what the solutions can be using, again, seller financing. All right, so here we are, creative financing, okay? Here's the first scenario. What if you, okay, you, the borrower, the watcher out there, what if you don't have the down payment, right? What if you have a low down payment or you just don't have it? Or what if you have bad credit history, right? It's going to be difficult to get a loan for your mobile home park. So you're going to have to resort to creative financing. But what if the park is not bankable either, right? What if the park has high vacancy, has low income? Let's say the seller hasn't raised their rents in 10 years, so that the park does not qualify for a bank loan. Or what if it's in poor condition, meaning the roads and the other parks and the utilities are in very poor condition, but it has great potential. But the lender says, no, there's too high of a risk for us. So you're going to have to resort to seller financing. So it's either you don't qualify or the park don't qualify. Either one, we need a solution. Here's the solution. The solution is creative financing. The first solution is called the Master Lease Agreement. And there is a video that will appear on the screen. It's a way of buying a property where there's no banks involved, there's no appraisal. You can put a low down payment or sometimes no down payment down. Whatever you can agree with the seller to as what the terms will be what the deal is. And you guys have always heard me say this: when you have a motivated seller and you have a motivated buyer, that's you, beautiful things can happen. And our company has a rich history of making beautiful things happen for our students using creative financing. All right, so we initially teach the Master Lease Agreement as making a 10-5-5 offer. 10-5-5 means 10% down, 5% interest-only payments, and for 5 years. So 10-5-5. That's our offer. That's where we start. Watch this video, right? If you can pull this off, you're going to create massive cash flow and a massive return on investment because you're only putting down 10%. But you have to learn how to get the seller's motivations out of them so you can structure the deal around the seller motivation. I teach you how to do that in this video. Go ahead and watch it. But this, we teach all of our students how to do, because it's not a matter of if they will run into a seller that's not bankable. It's a matter of when, and you need to know what to do. All right. We have several techniques that we teach our students. This is just one of them. So watch this video. All right. Okay. So that's the first solution. Second solution is what we call the seller carry first mortgage. This is where basically the seller becomes the bank for you. Okay. So watch this video. The seller becomes the bank for you. How does that work? Well, let's say the park is $400,000 and they want 25% down, which is $100,000. And the park, let's say the park is not bankable. Okay. Doesn't have enough income, is poor condition. You can't go to the bank. So what do? You're going to have the seller become the bank. So the seller is going to hold the mortgage for you. The seller will hold the note for you. You're going to pay the seller down payment, and then you can work out the terms that way. Very popular amongst mobile home park deals. A lot of deals in the mobile home park in the mom and pop range, okay, happen with seller carry first mortgages. All right. Thirdly is hard money loans. Hard money loans, I will show you a link will appear on the screen so you can see how that works. This is basically for value add types of deals, meaning that the park or you didn't qualify for the loan, so you're gonna go to this lender that's really not a bank. It's a small company or person that's going to lend you money at a higher interest rate, at a higher down payment, but you know that there's a big win on the back end. So in 2 or 3 years, you're going to fix up the park, raise the income, make the NOI great, increase the value of the park. So when it comes time to pay off this hard money loan, you can do it easily. Okay. So it's expensive. Okay. So hard money loans are only for this situation where banks don't work, where you can create a lot of value because these are so expensive. The interest rates are high, 12, 13, 14%. Down payments can be large, right? So you got to make sure that hard money is only used for value add types of deals. Just like our student Gilda. Gilda's picture will appear on the screen. She is one of our students. She's awesome. She has inspiring video. She does this for her adopted kids. Her picture will appear there. She's awesome. Watch her video. Okay, she used hard money to do her deal, and her deal is fantastic. And it's her first deal, by the way. All right, and lastly, we have bridge loans. In this case, a commercial bridge loan. A bridge loan, what it does, it's a temporary loan, okay? That is for temporary loan situations to bridge you over into the more permanent or long-term loans. All right. So here's a quick example. Let's say the mobile home park you're looking at it needs help, right? Maybe it has a vacancy issue, or it needs some things to be fixed up, right? And it's not as bad as a hard money, but the lender buys into it. Lender says, okay, we are a bridge lender. We will give you money temporarily, and it's a little higher than average, but we understand the risk and what you have to do to get to the other side of the bridge. And they will loan you money on this side so that they can bridge you over into the long-term scenario and give you a loan that will lock you in long-term. Okay, it's called a bridge money, commercial bridge loan. All right, so these are the four: master lease agreement, seller carry first, hard money loans, or bridge loans. That will help you with creative financing. If you can learn these four, you will be a very powerful and knowledgeable commercial investor. All right, especially with mobile home parks, because a lot of mobile home parks, you're going to run into situations where only seller financing will work. So you need to learn this stuff. Great. Let's move on to number 3. Here we are, number 3, the third way to finance your mobile home park investment. The third way is what I call large park financing. What is a large park? Well, how I define a large park financing is when the loans are greater, the loan amount is greater than $1 million, okay? That's when different lenders come into play and different requirements come into play as well. And the pricing is about, this is about an average, okay? So you're gonna start from 2 million and work your way up to 50 million plus. So these are the larger parks where the big boys tend to play. Next is, most of these guys here have experience. So these are experienced mobile home park investors. They play in this space here. It's a very competitive space. Soon as something of this size comes on the market, a lot of investors come in to buy it because of the desire to own one of the greatest hidden gems in commercial real estate, which is mobile home park investing. The demand is so huge, okay? Little supply, great demand. There are obviously more finance options I'll get to in a second, but here's an interesting fact here. According to Freddie Mac, mobile home park loan defaults, where loans become delinquent and then they go back to lender, mobile home park loans are 50% lower than multifamily defaults, okay? So the mobile home loan defaults are, from a lender perspective, safer than the typical multifamily loan. Interesting fact, huh? All right. Okay. On the lender side, the first lender will be a regional lender. A regional lender is a bank that has several branches in multiple states. That's a regional lender. As opposed to a small local lender, which is only in that small town, a regional lender is in multi-states. Okay, let's get to Fannie and Freddie, okay? So Fannie Mae, Freddie Mac, these are what we call government insured loans. You can get them through a broker only. And the way this works is, for Fannie and Freddie, a mobile home park loan, a regional bank, for example, would lend you the money, but the government will insure the money the regional bank is lending to you, right? So for further security, the reason why Fannie and Freddie does that is to have more loan dollars out there available for us like you and I to create more affordable housing, okay? So they have an annual mandate to lend out X of hundreds of or billions of dollars every year so that we can keep the housing supply headed in the right direction, okay? Fannie and Freddie also has the best loan terms today. They offer a 5 or 10-year fixed interest rate amortized over 20 or 30 years, okay? So pretty decent loans. Again, you have to go through a broker to find a loan broker to find and get a Fannie or Freddie loan. Okay. All right. And we have a CMBS loan, commercial mortgage backed securities, right? This is a securitized loan. And what this is basically a lender will put together multiple loans from different borrowers, different states, and they'll bundle them together as like an investment package, and they'll sell them to Wall Street for a return. Okay, so it's called a securitized loan. This is very popular in multifamily, but also in the mobile home park world too. Okay, these rates are somewhat comparable to the Fannie and Freddie, and so are the requirements. The requirements for one, with the regional Fannie and CMBS is, your net worth to play in this space needs to match the loan size. So if you're getting a loan for $2 million, they want to see your net worth at $2 million too, okay? So you're starting to get into the big boy world, and most of these loans, except for regional bank, most of these loans are non-recourse, meaning there's no personal guarantee. So if you honestly mess up on this property, a disaster happens, and you have to turn the loan over to the lender, but they can't come after you for personally take your home, things like that. Okay, so non-recourse. So you eventually want to get into this space, right? This is where we play. And the loans are assumable, meaning that if you, after a few years, you wanted to sell the property and you have a great interest rate and you think it's attractive to the next buyer, your next buyer can assume this loan that you get from this lender, okay? And let's see, as I mentioned before, they require a track record. So because they're lending you millions, if not tens of millions of dollars, and sometimes it's non-recourse, they want you to have a track record, okay? A track record of success and ownership in the mobile home park space. There's also after you close, there is a liquidity requirement. Liquidity means cash, okay? There's a cash requirement closing. They want you to have in your savings, not your down payment, but in your savings account after closing, 9 to 12 months PITI, okay? Principal, interest, taxes, insurance. So 9 months of that, somewhere, just in case something goes wrong, you can write a check and fix it, okay? They want that. Again, you're playing with the big boys, so it requires more big boy responsibilities and requirements, okay? All right, and most of these lenders won't lend on mobile home parks where you have at least 20% of the homes are park owned, okay? So they don't like it, and in a couple minutes, I'll get into why they don't like it and what the workaround is. All right, okay. And then lastly, this is where you want to end up playing, and right in this space here, okay? So you're gonna start off perhaps with number one is with a small park and do that financing, or you can do number two, which is creative financing, but after you get that experience, you wanna work yourself into this space. This is where the big boys play. This is where the big dollars are made. This is where the generational wealth is made, okay? It starts with number one and number two, but this is where you want to end up. Got it? All right, okay. What I want to do next is I want to get into the three most important questions when thinking about or doing a mobile home park. Let's do that next. All right, here we are. Thank you for hanging out with me. I'm going to wrap it up here with these three very important questions. And the reason why I have them is once you jump into the space or the world of mobile home park investing, you're going to run across these questions. I guarantee it, 100% this will come up, and I want to help you know what to do in this case. All right. So the first question is, how do you finance a mobile home park that is 50% vacant? All right. Again, you have 80 spaces where only 40 are occupied. From a lender standpoint, that's a distressed property, right? Why would they want to lend on something like that? It's too risky. So here's the solution real quick. I share with you the master lease, okay? Seller financing, work with the seller and create a 10-5-5. As I mentioned before, you can do a seller carry first where the lender becomes the bank. So in both cases, no lender is required. There's no appraisal required, okay? So you can do this between you and the seller, or you can do a bridge loan where you can go to a lender who understands that the property does have upside once you get it occupied, and they will lend you the money to buy it, to fix it up, to bridge you over into their long-term loan financing program, okay? Or you can do a hard money loan, which is a short-term loan, right? That's available for value add types of deals. All right. So that's the answer to that one. Question number 2 is, how do I finance a park with lots of park-owned homes? Okay. As I mentioned before, lenders don't like park-owned homes because lenders want to lend to the dirt only. Okay. Only the lots. They don't want to lend when you have the dirt and a home on top of it where the tenant is paying for the home in the dirt. They don't like it. Right. So how do you get around it? 2 ways, right? I have this video that I produced. It's called The 3 No-Nos of mobile home park investing. One of the no-nos is avoiding the mobile home parks where there's lots of park-owned homes. Don't avoid those. There's a way to do great deals with those types of situations. So watch that video. The link will appear right there. The second way is to just do 2 transactions, right? So when you can go to the lender and say, lender, I have this home with a park-owned home. I want to do 2 transactions. So I'm going to, I'll do a separate seller transaction on just the homes. I just want you to lend on the dirt. So you can arrange a structure, something like that. So that's a solution. And again, I go over these questions because you will run across these situations. And number 3, as a beginner, where should I start? So I want to help you out here. I want you to start small. That's my recommendation, to start small and get mentored. Also my recommendation, if you want to be mentored by us, by me personally, a link will appear on the screen so you can get started with that. And again, you're going to start small and get mentored so you can avoid the costly mistakes and get results, right? That's the whole goal here, is to get results and avoid mistakes, avoid the pitfalls. So get help, okay? Start small, right? If you have any questions on what I did this whole session here, training session, you can text me, okay? Text Peter to 833-942-4516, and we'll get right back to you. Any questions at all that you have. All right. Thanks, everyone. If you hung out this long with me, you are my favorites. Thank you for watching. Again, if you'd like to get mentored or learn about our program, a link will appear. Click on it and check us out. If you want to just read a book on commercial real estate investing, download it and go at it. It's free. All right. Just go at it and just read it and get educated. Do me a favor. Go ahead and like this video. Go ahead and subscribe to our channel. And again, I just want to wish you a great day and thank you for hanging out with me. I'll see you at the next video.